Warriors, Shahab, Mike, Brand, Ryan the Warrior.
Morning, Sir Dale.
How are you, buddy?
All good, mate. You?
Good. Okay. Getting a nice little pop in cable, especially, but Euro 2.
You've witnessed history, Dale.
What's that?
Bank of England's Bailey spoke and cable went up.
Oh, okay. So was he hawkish?
No, nothing to do with him, of course.
Okay.
No, it's just general dollar weakness we're seeing a bit at the moment.
Yeah, pretty good give back here in EG. Weakness in yen, so you think that was it? I know you're looking at 133 as important resistance level.
Yeah, I don't think it's out the woods yet. We keep flip-flopping around whatever's happening in Japan with the new Bank of Japan governor. There was headlines out overnight. You see that spike in the shorter-term charts.
Yeah, this one.
Yeah, we've got to wait. Valentine's Day, apparently, when we get all the nominees, and next week, same time as CPI, I think. So we'll get the Bank of Japan first thing, hopefully, and then CPI after that. So it could be another fun day.
Okay. Well, I know that Greg had talked about selling a rally in euro, 108-ish, something like that. Looks like the dollar on this pullback still could just be an ABC before we get another wave up. To me, I don't want to see it take out 102. So if I could get long as close to 102 as possible, I would try it.
And nice low risk.
Yeah. And S&P's closed lousy yesterday and then gap up, open up higher today. Having a hard time breaking through that high 4,200 so far. Trying like hell.
Yeah.
And the metals still don't. Yeah, metals still don't seem ready.
Yeah, I mean, if the S&P goes, it's probably 43 next, isn't it?
What's that?
The S&P, if the top does go.
Yeah, 43. I think Blake has the same internal line up here. Up around, that's the August highs up here.
Yeah.
We could pull back first, so, pull back towards here and then blast again. Everything can happen. So platinum, let's take a look at platinum. Doesn't look ready either. So any big news today? Economic data that you're looking forward to here in the U.S.?
It's a quiet one. All we've got is jobless claims, but I think that might have a bit of significance today. With all the talk around the jobs market, it's the only piece of data today. It's been strong since beginning of the year, and I thought that might just be some early year stuff skewing coming in. But if it continues being strong, it's going to back up what we saw Friday with the NFP. So it could be a bit of a mover today.
Okay. The gold silver ratio trying this resistance level again and the 200-day. If it's contained by this, silver will become the preferred long. Still think we'll see the 21 handle. Not sure, if it gets to 21, but I think we'll see the 21 handle. Remember, the whole world was looking to buy silver at 22.5.
Yeah.
22.50, 22.50. Well, where are they? So, it's that same thing when everyone's looking for one number, it doesn't achieve it or it melts through it. So I think we have the melt through it. So far, it's pretty meaningless, 22.50.
Yeah,
22 is pretty important.
Yeah. 22 even,
I don't know how people got this 22.50 stuff, but we could come close to this 200-day here, 21. And I think I didn't do the fibs, but perhaps 21 is 61.8 back, something like that. And gold, I'm thinking 1820 to 1800, in here. So we'll see what happens.
I don't know if Kay's got the fibs on that one.
On what, silver?
Yeah.
What's 61.8 back there, Kman?
Hey guys,
How are
good
you, buddy?
morning, Dale. I have those low 22s just like you. Those low 22s I have.
Nothing
Also a
underneath?
little bit of a shorter term trend line coming in there. I do have those low 22s, so we will have to see what happens. But it's all driven by yields, right now.
Yeah,
Yields come off a little bit. They both take a breather. Yields go back up. They both getting hammered again, I reckon, and that'll continue into the CPI, in my opinion. And then we'll see if we need to really take a fresh direction.
yeah, yeah. So I know just this little formation here measures 380 if we don't
Yeah,
negate it.
it's really keeping me back from trying to catch a knife on those metals. I think the ultra long term and nothing has changed for me, but I'm really very 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 small now only in silver and just waiting because I still think, as you say as well, that the market will need to reprice a little bit on those rates. If we're going to stay higher for longer, or who knows if inflation is getting sticky that we need to even wait for longer even than than the end of the year, or it's those metals could still be very much affected. And we've seen what they can do. You see silver 24 and a half down to 22, low 22s. That's
Quickly
it's
after it
10%
finally
move, right?
happened. Yeah, yeah.
It's 10% move. If you have serious positions in your account, will feel that. So I'm very cautious right now.
What do you have underneath 22 for your next level if it takes it out? Did you hear me?
I was thinking, holy cow, did I just lose you guys? Good morning,
Yeah.
Dale.
Hey, Blake.
Oh,
Yeah,
sorry.
Yeah, we lost Kman
Sorry
there.
there. Yeah, no, it's me. I went on mute. I think below 22, I'm looking at around 21, 2090, 2105-ish.
I like it.
Yeah.
There's a 200-day right there. I'll take a stab at some shares down there.
Yeah.
How you doing today, Blake?
I'm awake. How are you doing?
Hanging in.
As we get towards the end of the week, right? We always kind of get a little bit more tired. Do you say hanging in there?
Yeah.
Yeah. I'm doing good. Just this market, we're kind of at a standstill, and I'd love to get everybody's thoughts here. Can I just show you something real quick,
sure.
Dale?
No,
Yeah,
show anytime, Blake.
Yeah, the thing that has me right now, and this is I just did this update here. I'm going to explain a little bit. This is the S&P. I've got the S&P drawn a couple ways. I used this one for the week ahead video, and I was showing a couple weeks back how expected to move up to 4,200 reversal. We got that. But now that we're up here, we're doing this consolidation, right?
Yeah.
And a consolidation in a bullish trend, as you see here, we are trending higher, whether you guys like it or not. You may say, well, over the last couple of years, we're trending lower. Yeah, but over the last, several months, we've been trending higher for the most part. That means, there's a bullish consolidation, right? I mean, shallow retracements, it's not going down. The propensity right now is for it to go higher. We have CPI data coming out as everybody knows next Tuesday. Right. But the way this consolidation is happening right now, there's a good chance that we can break either direction ahead of the data. Yeah. So ahead of Tuesday. So if we're only going to tighten so far, and then over the next, I would say 24 hours or so. I know it's already Thursday, but by the end of the week, we could break out higher, we could break out lower. But what I think the risk is whatever the breakout happens, it could end up being a false break. So that's the thing that you have to, I'm not going to say fade it. I'm just going to say that the real move is going to come on Tuesday. So if we get a move like what I hope happens is, we get a move like this higher, tomorrow, and maybe Monday or Tuesday, we push even a little higher, and then we get some strong inflation data, and then we reverse. And the reason why I love to like kind of think about what may happen, but I'm going to get everybody's take here is, we, to get the market to move higher, because the market's just kind of grinding higher, and then to get it to reverse, the way that would happen is we'd have to see a stronger than expected inflation print on Tuesday. That would definitely stop the markets and make it go lower, and the dollar would turn around and rip. And the only reason why I'm thinking that, well, not the only reason, but there's a few reasons why. We had the Riksbank meet while I was sleeping. So were you, Dale. Ryan, Kman, how'd that central bank meeting go?
Very hawkish.
Very hawkish. Yeah. That's weird, right?
Yeah.
Very, very hawkish. There was another central bank that was pretty hawkish this week too, right? The RBA. Well, I mean, they set expectations.
Comparably, Riksbank was much more hawkish because the Swedish krona has really lost a lot of terrain, so they can be much more hawkish. But yeah, it was very hawkish because they hiked 50 BP, saying more to come in spring, and starting to sell some assets. So yeah, they were very, very hawkish, and looks as if the rest of the market paid attention to it as well. And then, yeah, at the same time, the US yields are cooling off a little bit. We're back below 360 on the 10s. Why, I don't really know, but seems like the market is trying to manage the books into Tuesday CPI. But no, the Riksbank was very hawkish. So dollar stocky is about 2% lower. Euro stocky 1.5%. Yeah.
Right. And I guess the reason why I want to point all this out is, how about if the inflation story really is, not as transitory as people think, right? Maybe it's a little bit more sticky, and maybe the Fed has to be more hawkish. And I the reason why I point all this out is I'm just thinking about like setting up and how we're going to trade it the next couple of days, and kind of what's happening around us. And that's really, what we do as traders, right? We're like, okay, well, how can this really play out over the course of the next couple of days? And, I'm very well aware the stock market's bullish, and I'm very well aware that we are consolidating, and, that there's a higher probability of us breaking out in the S&P higher than lower. You look at the dollar looks like it might continue to weaken here. But, is that getting, people that got really bullish the dollar, is that just getting, those traders wiggled out before really what's maybe more to come is a more hawkish Fed and maybe stronger inflation? What are your thoughts here, Ryan? What are your thoughts?
Yeah, I think it's in the balance still. Now everyone's expecting inflation to come down, and it should come down. But is it going to come down as much as people expect it to be? And that's right. The message the Fed have been giving of late. Inflation is coming down. Is it going to come down as much as the market thinks it is? They're going to play obviously from the cautious side and say, well, in case it doesn't, we're going to be ready, because they don't want to get kicked up the arse again. And if it does carry on going down, they go, hey, look at us, we did it, we did the job. So yeah. It's a bit of a win-win if you're a central banker at the moment. But we know the data's not looking as bad as has been expected. Recessions may be avoided, or they're going to be shallow. It's going to come down again. Who's going to have the best economy? And at the moment, if this data continues that we saw Friday, the US is going to come out on top again.
Yeah. And so when I see the dollar weakening the way it is right now, and I know we're back below 103, this is, in my opinion, it's like a setup to be a long. And I know earlier this week, we knew that the dollar index was going to reverse from, the 104 level. It was channel resistance. It was 160. It was a 618 retracement of this move. You can see it right there. And let me just go ahead and change this a little bit. It was the 618 retracement of this move. Is 161% extension of the last leg lower. So we hit the confluence of resistance. We reversed. It was channel resistance reversed. And we're pulling back, but I think you got to buy this pullback. And, you know, one of the other things, and I want to hear from Steve here, because I'm sure Steve has something to say about all of this, is that, you know, you look at gold, man, gold's just setting up to take a big dumpster dive. And I know I talked about this on the trade-off. So Ryan, don't you even try to steal my gold trade when you go on with Mr. Michael Brown. But the gold market looks like it's set up just for another plunge lower, and that would be a, you know, what I mean by that is, you know, seeing a move that looks like it's going to look like this. You know, well, here I can just draw it out.
Can you talk a bit slow? I'm just making notes.
Yeah, I know you are. So it'd be an ABC move like that would look something. I have to redraw that. All my old drawing tools are gone. So anyway, it looked like this, you know, a move lower in gold. It hasn't rallied with this dollar weakness, and I think we need to keep that in mind. So Steve, what say you regarding inflation pressures, what the Riksbank's doing, what other central banks are being so hawkish this week? What are your thoughts here?
I think that central banks really lost a lot of the remaining credibility with the inflation event that we had, right? Supposedly that is their number one targeting, and they utterly failed. Not only they utterly failed in containing inflation, but they utterly failed in predicting inflation. I mean, they were telling us until the last moment that they expect a very minor jump in inflation that's going to be super temporary. And of course, going all the way to 10% inflation was a big issue that wasn't anywhere clear near what they predicted. So I think they are not willing to err in the same direction again. And if there is something we learned from the last time we had inflation pressures several decades ago, to be frank, in the 70s, is that inflation can be sticky. Right. And yes, we are seeing a pullback in inflation. And yes, I do believe we might see a further pullback in inflation, but it's too early to predict victory. Right. I mean, it's not victory if you go from 8.5%, 9%, 10% inflation, depending on which country we're talking about, down to 6 or 6.5%. Inflation should be, according to their targeting, below or at 2%, and they know that it's one thing having a pullback in inflation, and it's a second thing actually making it all the way down to 2% and stabilizing there.
Right. That's, I mean, that seems like a far cry from where we're at right now.
Yeah, we are a big distance from that. So that's why I think central banks remain on the hawkish side, and that's why I don't think predictions for very, very fast pivots are going to prove to be right unless we have some major recession or financial event with whatever repercussions that might have. But we're not there yet. So for the time being, I think it makes sense to expect more of the same.
All right. Well, you know, I'm really going to be interested to see next week's. Obviously, we all are next week's inflation print, because everybody expects inflation to really moderate, and that's, I mean, people are banking on it, obviously, and I think that the market could be really, really caught wrong-footed if we see strong data come out. I think the market could really, really take a tumble, and that's why I think it's going to be so important. But we got to. It's the trick that's navigating between now and then, right? Let me ask.
Obviously, the closer we get to the inflation data, I assume that the more the market is going to find some kind of a consolidation area and
Right.
stay there, right? I don't believe that people will be betting one way or another a day or a couple of days before the data.
Yeah.
But until then, we might see a little bit more continuation to the moves that started on Thursday and Friday. Because don't forget that Friday was the catalyst, of course, for the dollar's acceleration higher, but there were several markets that had already reversed on Thursday, a day prior to it.
Yeah, true. Hey, real quick, I want to shift gears, and thanks for your input there, Steve. I'm going to shift gears really quick. I want to talk about Nick of Jupiter. I'm gonna go ahead and put the link to this tweet in, and this is from for those of you that are, I'm putting it in the chat box here for everybody to look at. If you guys are interested in the trader funding program, that's somebody who's been listening to our shows for 7 years or so, and he's blown up accounts. He's gone up, he's gone down, but he's also passed a trader funding account a couple of different times. We gave him a very large payout just a couple of months ago. It was that we had to authorize. So make sure you check out that link to this tweet right here. Go read the blog. It's actually right here. I'll take you to the blog, and then you can get to the video from here. That's Nick right there, Nick of Jupiter. And so check it out. It's pretty cool. He's like I said, he's actually failed our assessments a couple of times. He's passed several assessments. So he's going to give you kind of some tips and tricks on how to do that. And next week, my video will be out. I know you guys have been waiting for a few weeks, but anyway, that's coming out too. We're just wrapping that one up. So last thing I really wanted to talk about today, guys, is that this market has been really choppy and it's been really challenging. I don't know how you've managed this week, but I want to talk a little bit about it, because this has been my week. I'm gonna just take you into our trades rooms. This is one of the things when you're inside of our community, you can kind of see what we're buying and selling. We have a general chat room, obviously, that we're all, talking about, well, right now everybody's saying good morning and talking about the markets and what's happening. And this is just, everything that's happening here. But the trades room is where myself and other traders, we post like what we're buying and selling. And if you look at my week, I post, what I'm buying, what I'm selling, where I got in, where I got out. And I'm usually in the general chat room talking about it. And so are other traders. But if you look at my week, I've had some, I took a 11 pip loss on the Aussie. I made 9 pips on the Kiwi, and then on my overnight trades, I end up, squeezing out like 40 pips in the Euro, because those was from overnight. And then, I just got out of my dollar rand basically for break even. And, my week has been really just kind of getting, I feel like I've been a gerbil in a gerbil ball, those balls that you just keep running around in circles. That's how I feel like my week's been. How about you guys? How have you navigated this week, Ryan?
Yeah, pretty much the same way. I've not done an awful lot, to be honest with you, because the same thing. I think we're in a bit of a flux at the moment, a bit of a Mexican standoff. The pivoters had their moment. They went into a brick wall. Maybe now the hawkish side are looking to take up the reins again, but everyone's sitting around waiting for the CPI data because that will give us the next idea. And I think we're in that period. We're in a bit of a flux. I still think the dollar is probably more bid still than rally sell, but you look at euro dollar, it's bounced off that. It took a few to the cleaners, was it yesterday? And then it bounced back above 107, but it's not rocketing, not even cables rocketing, it's up, but you just get the feeling they're all skating on thin ice at the moment. So trading wise, I've not got a lot of interest, bar managing what I've got, unless I see a good
Thank you, Ryan, for that. That's a very honest assessment of what's going on. How about you, Kman? How have you been navigating this week? I mean, it's been choppy, right?
Yeah, it's been choppy. It's been relatively good until this morning. Because
For you anyway.
I'm short cable from about 40 points below here, and I'm scratching my head a little bit whether I have to keep it or not. But the rest has been really. My open positions are on autopilot, buy low, sell high, manage the same risks in the crosses, and just let the market do its thing really into the CPI. It's going to be it's just a real chop into the CPI, and then yields are. I think the correlation algos have a grip on things right now. If you look at yields are a little bit lower, dollar goes lower. If the yields jump from this, let's say the 10s 356 358 and it goes back to 365 366, the dollar will likely be a bit stronger again. And
you know that you just bring that up, Kman. I mean the dollar index, which happens to be right here.
No, I'm not talking about the dollar index.
Oh,
you know,
I thought you were talking about the dollar
look
index
at the DXY.
moving when yields move.
Yeah, yields, yes, but that yields are driving the dollar, but different pairs in different speeds. But yeah,
Man, look at that correlation.
Yeah, the correlation now is pretty strong because
like
the big boys are probably not doing much, and they are not driving it here or there. So the correlation algos have a free hand.
Yeah. All right. Well, great observation, and I have a feeling it's going to be kind of like this. Tony says, even okay, good. So the pros don't even know what's going on. I mean, we just got off of real big central bank meetings and a non-farm payroll that kind of blew everything out of the water and really expectations out of the water. And it left the market, I think, stunned. And so that, I think everybody realizes how important this data is that's coming out next week, that the market is truly data dependent. And the NFP
absolutely.
really put the screws on people that thought otherwise. So, so anyway, Dale, what are your thoughts this week as we do have, as Mike pointed out, we do have unemployment data, just weekly unemployment data. We haven't seen the weekly jobless claims move the market in so many years, but I'll tell you, it's coming. It's coming. It may be next year, but it's coming. So we'll pay attention to it. But Dale, what are your thoughts?
Well, I was just thinking about what you were talking about, where you visualize what a market can do and potential patterns that could emerge. And it made me think of what Larry Williams said, that as traders, we live in the future because we're always looking ahead, right? So, that's where we live. We all, it all happens in the present moment, but we're always looking ahead. So as a trader, accept it. Don't look back. You live in the future.
And it really comes up. I know I've said this for years. For those of you guys that have been listening in for 15 years to my ramblings, I always try to plan my trades and then trade my plan. It doesn't always come to fruition, but I always try to plan my trade. But there's a couple reasons why I plan my trades. It's more not only because it's like a great exercise in trying to put the puzzle together, but it's also confidence building too. Like if I say, well, I'm expecting the S&P to rally from here, and then next week we're going to get a stronger inflation data. I think the risk is we get a stronger inflation data, and then we just turn around and we sell off after we hit new highs and stop all the longs out. Everybody gets long and they get caught chasing the market, they reverse. And then if that all happens, that for me is confidence building, a confidence building exercise that I do. And it helps me because, I don't have great days all the time trading. And if anybody says that they do, they're absolutely 100,000% lying to you. We have bad days as traders. And so when you get knocked down and you get, shuffled around, there's things you have to do to build confidence. And one of those for me is, planning my trades and, and really, seeing them come to fruition as I see fit.
You know what else builds your confidence? Seeing other people's work that come to the same conclusion with different methodologies is very strong confluence to me. When I see that, something I'm looking at, Greg is looking at, or you talk about it, and we come up with these narratives with different methods, and that adds conviction and confidence to the trade as well for me.
Yeah. Sorry. Weekly unemployment came in basically in line. Dale, you remember, well, actually everybody here listening in remembers the day that we remember when weekly jobless claims were like at 400,000.
Oh.
We'd actually see them move the market. Like every Thursday, we could always we could expect like a 20 or 30 pip move in the FX market as soon as that data came out. But we are far from those days, but they are coming. I promise you guys, they are coming. One day we will not be at weekly jobless claims at 200,000, which is so incredibly crazy to me. And I'm sure Lakshman's going to talk about this too. I mean, this is employment, tight employment that we haven't seen. I haven't seen in my lifetime ever, even when I was a little kid, and not like I was paying attention. I was paying attention to like Transformers and all that other stuff.
That was a job.
Yeah. Anyway, hey, I want to say, as a 70s and 80s kid, hey, have a great day, everybody. Thanks to everybody for being with us each and every day, navigating through these markets. Dale, thanks for guiding us. And Kman, Ryan, I know Steve already left for a meeting, but Kman, Ryan, always appreciate your inputs. And by the way, if you guys don't listen to if you're European or in Asia, and you don't listen to the Flow Show, it is free to listen every morning, to listen to Ryan and Kman and Stelios, even though Stelios is in the UK right now, traveling. But if you guys aren't listening to that, I just put the link in the chat room. Make sure you guys are listening in, because you guys can hear their analysis every day. I wish I was awake. It happens to be, I'm in the middle of my sleeping time when they're broadcasting, but you guys make sure you listen in, and get caught up there. So thanks, Kman.
And that proves that Blake copies us when he does the trade-off.
No, that's not true. That's not true. You are watching all of my stuff that I do in Asia and then coming on Europe and doing. I'm just kidding. Hey, man, it's great having a great team like you guys. So thank you, Dale. And
you're welcome. Don't be a copycat, everyone. It's a big fine. The IRS will fine you for copying. Yeah, and here's someone that cannot be copied. Lakshman, welcome back to F.A.C.E. with your original work. What a great time to have you. You with us?
Yes, I am with you. Hi, Dale. How are you?
Hey, good, Lakshman. What a great time to have you, with a lot of confusion about where the economy is at, and people are saying now we might skirt a recession.
Sure.
Soft landing looks like it's a layup. Really great time to have your views to crystallize kind of a muddy picture.
Yeah. Well, thank you for having me on. It's great to be back with you. You're right. Tons of cross currents, I would say, and as kind of strange and new and kind of never been seen before, all these things that we're seeing, the idea that there's a lot of cross currents around the onset of a recession is pretty standard.
Okay.
It's
are you
not
are you going to be sharing your screen,
buddy? Sure.
I know usually you have some visuals that you want to share.
Oh yeah, I can share.
Okay.
Hi everybody.
How you doing,
are you?
Bud? Good.
Let me see. I've got all there's all kinds of stuff. Where do you want to go? What do you want to talk about?
Why don't we start with the Fed versus the economy, and the fact that we have this employment picture, but manufacturing's in the tank. So all right, so we have this one sticky problem, right? That and yields, to me, all right, here, a picture speaks 1,000 words, so I'm going to share my screen here on
Sure,
yields.
but the more, I think this whole everybody got prepped for recession. Yields they went down quite a bit, and now they're back up a little bit, right?
Yeah, but I mean, this whole thing looks corrective, and didn't give it up easy. Of course, if we drop under 330, there's room, but if we hold 3.5, I think we could see 380 again.
Well, look, inflation's
Why can't we see new highs in yields, Lakshman?
why can't you see? Well, you might look. This is ancient history, but in '08, in the first half of '08, the recession's underway. It starts in December of '07.
Okay.
Back then, it was kind of a mirror image of what you have now, in that jobs were actually weaker, but GDP was growing. And because of that, everybody was focused on GDP, saying there's no recession. What are you talking about? Oil is going up. The charts you were just looking at would have shown Fed tightening priced in for 100 basis points by December of '08. And that's inside a recession half a year, right? So that's how far off you can be. Now, inflation was sometimes runs up inside of a recession. That happens. So we can, and that recession, to be fair, started off mild. It was a relatively mild recession because there's two things. One is it a hard landing or soft landing? That's the first question. We should talk about that right now. The second is, well, how bad is it going to be? and that's a tougher one.
Well, Bernanke thought things were contained.
Yeah.
Initially.
I mean, and so I'm sure, there's a number of people who are saying things are contained now. And
there are.
I won't pick on them. I'll be polite. I won't name them, but there. And we would disagree. Now, one of the things I think to understand, Dale, is that, all right, so we're looking at cycles. I'm the third generation of doing this. My mentor was the guy, Jeffrey Moore, who created leading indicators. So there's some institutional memory of looking at these cycles, and each one has a different story. And in this, I want to be clear that we were making our recession call last spring. It's a long time ago. All right. Yeah. Now, I think and I'd be happy to, if anybody has a different recollection, but I think most people kind of got on the recession bandwagon after the Fed started going fast. They started doing those 75s in July, and that woke up a lot of market participants, and they said, okay, that means a recession. Now we've got to price one in. And they did, right? I mean, all kinds of markets moved pretty aggressively. And so now you have the prospect of the Fed kind of toward the end of its cycle, whatever you want to say. Either they're slowing down, they're going to stop, they might even turn, depending on who you talk to, right? But that embedded in that is the idea that the recession risk was predicated on the Fed. Like it was because of that there was going to be a recession. And of course, we were making that recession call earlier. So why were we doing that? Right? So we were doing that because of the forward-looking drivers of the business cycle. And it's not terribly unusual. They were goods-related drivers in this case that were that had gone to extremes. Remember, we're in the aftermath. We're in the, what do you call it? What's that? The air behind, the turbulence behind an airplane when it's all kind of crazy. We're in the aftermath.
Oh, tailwind.
The tailwind or whatever
becomes a headwind. And
yeah, so we're in this.
I want to just
thing behind COVID. Yeah, go ahead.
Yeah, that we didn't have a strong economy prior to COVID. It's almost like COVID bailed out the economy with stimulus and kept the consumer going.
Yeah, I mean, I cannot answer everybody on FinTwit, and there's a lot of people who say things that don't make sense, and there's some people who just may not know. I was to that point. I was looking at a comment the other day where someone was saying that the 01 recession was caused by 9/11. And of course 9/11 happened. First off, I find that offensive because you don't want to give the terrorists that kind of power. Second, it happened just factually 6 months inside of the recession. Yeah. So the recessions start, things happen, people remember them. There was a big bank the other day had a letter out where they had mentioned that the 07-09 recession, the Great Recession, you should get these basic dates right. Started in May of 08. It didn't start in May of 08. In May of 08 is when the market realized, whoops, we're on the wrong side of this. But the recession started in December of 07. So here, the foundation of this recession is coming off of the extremes that we got out of COVID. We got crazy stuff in housing. We had crazy stuff in goods. And we all know it went too far. And that's going to correct. And as that's correcting, as we're seeing that correct, those forward drivers, they don't stop where you want them to. they kind of overdo it and go too far. And
they have their own momentum.
Yeah.
Right?
And so that's going on. And then on top of that, let's now pile on that. When we pile on that, it's not just the US, it's in Europe, it's in Asia, doing the same thing. Now let's pile on it further. They pretty much all missed the inflation cycle upturn. Let's just say that they did. They totally missed. That's the big that's the elephant in the room. Really, 2018 they missed it, and then they missed it again here. And so they're playing this heavy duty catch up, which they have to do. I understand why they have to do it, and that's just piling on top of it. And it's inconvenient, but that hits the economy with long and variable lags. So we're just now starting to get on the economic, that's different than the market. On the economic activity, we're starting to get the hit from the earlier rate hikes.
Yeah, so people keep mistaking what the market does to what the real economy is. And there are times of disconnect. Would you view this as a moderate disconnect or an extreme disconnect, or it pretty much is the market trading with expectations of what you're talking about?
No. The market, I'd say right now, the market, if we put words in the market's mouth, it is pricing in a soft landing or no landing, right? It's saying jobs are strong, so there's not going to be a recession, and the Fed is near the end, so that kind of reason for recession has been nullified. So now we can look across. Okay, there's a couple of people who weren't good managers, and they're kind of going to take it on the chin. But by and large, we're going to get the soft landing. Now, that kind of we've been calling that the immaculate disinflation. That's not how it works. It doesn't work that way. Let me show you. I actually let me share, because it's been a busy week. Let me just say that I've been talking with a lot of people, so excuse me for my messy desktop here. Here is a chart. I think it's kind of interesting because this is what's on Powell's brain right now.
Right.
And just to orient everybody, we're looking at the 70s. So that's an era of higher inflation.
Three tries.
Yeah. So we're going from 67 when inflation was lower. Right, it's in the three handle, 2 to 3. You get into the 70s here, and we're showing the recessions,
right? And
you see these swings up and down. Those are your inflation cycles. And so when I talk about cycles or an inflation cycle turning point, that's what I'm talking about. And when we're talking about business cycles, it's just switching from the shaded areas, which are contractions in activity, and expansions in activity. So we're looking at two different things. We're looking at, you've got the shading on growth, and then you've got a separate thing, which is a cycle in inflation. This red line is the average for the period shown, which is 6.9%. Okay. Now, back here, nobody cared about inflation. It was jobs, right? So inflation runs up, you have a recession, boy, you got to be easy. It's all about jobs. Okay. Inflation starts to run up. We have oil embargo in here, but inflation's moving up cyclically first. Oil embargo piles on top. You get the recession, comes down. A lot of pressure here. This is interesting stuff. This is tons. I know Burns takes it on the chin, and I think some of it is unfair because the pressure political pressure that comes on from Congress and the White House there is massive. Massive. And so you have more easy policy in here. We have the Iran issue up here in 79.
That was a commodity mega bull on steroids, which makes what we have seen here in the last couple of years look like a walk in the park.
Yeah, what did we go to 910? We were over, you know, in
Yeah.
COVID stuff, we're about this level. So this,
Yeah.
but the point is, there's a cycle move. Yeah, there's a negative shock here that really blows it off. We have a bit of a recession. Volcker's in here now.
Yeah.
Okay, Burns is toast. Volcker's in here. Volcker's in here, and starts coming down. He eases. You know, I mean, you know, Volcker wasn't perfect, and on inflation, and it's sticky. This stuff is sticky. It takes this 81, 82. That is a year and a half international recession. It's a nasty one. That is not a walk in the park. I would not call that a mild recession, this one here. Okay. Yeah. And also, by the way, so we can be in an inflation cycle downturn. Currently, we're in an inflation cycle downturn. It's been going on over half a year. So we're in an inflation cycle downturn now. And recessions will kill inflation eventually. They don't do it immediately. So first, it's hard to get an immaculate disinflation, number one. Number two, the trough in inflation doesn't necessarily come right away. It's eventually. So these are different cyclical characteristics, I think, that not everybody is aware of in how this works. Now, Powell excited everybody in acknowledging that we have goods disinflation. Okay. Yeah. And so for overall inflation is coming down. But of course, services is not, and wage inflation. And, you know, I don't know if it's a verbal slip up, but on several occasions, he has said that he wants wages to come down. That's levels of wages. That's not wage growth. And, you know, maybe he's talking quickly or maybe he means it. But, you know, let's also turn to jobs. We have a super tight jobs market. What's going on? I heard the gentleman speaking just before about jobless claims in low again, right? So what's going on? How does this relate to a hard landing, right? People have been acknowledging that the unemployment rate is often at very low readings at the onset of recession. Okay, so that could be what's happening here. There's some other things that are going on, I think, that are interesting and that help explain the seeming disconnect between the jobs market and the recessionary outlook that we have. One is that we have seen this movie before. We going back to the 70s for a moment, when you have high inflation, relatively speaking, you have this so-called money illusion that can kind of seep into business managers' kind of thinking, because your top line revenue growth, it looks okay, right? Inflation's making it look okay. And so you're like, well, I've got that good revenue growth. They don't adjust it for inflation in their heads. It's not a natural thing to do. And so you're like, look, I charge 10% more. Nobody seemed to flinch. My revenues are up. Maybe my unit sales are down a little, or the size of my purchases are down a little, but my revenues are up.
That's what they care about.
Well, it's certainly distracting, right? It looks good. It sounds good. But when you get down to when you go to do the books and you're like, geez, how much of the product did I move, and how profitable was it? And when you start looking into that profits growth part of it, it doesn't look as good, right? That's that's getting dicier and dicier. And I think that's the thing that'll have to be kind of talked about or looked through in the coming quarter or two.
Lockman, did we have anything similar to the Great Resignation in the 70s? Or is this unique to this
Yeah.
period in history?
So
Because the baby boomers bought their houses 40 years ago. They own them. They have pensions. They don't have to come back to the workforce.
there's this, I don't think we fully understand the structural shift that has occurred in employment. We know there's the baby boomer stuff moving through and they don't have to come back. We know that COVID did something material to the workforce and may still be doing something in terms of long COVID or people taking care of other people who are sick and
Great
so on
point.
and so forth. A lot of people not in the labor force that typically would be there. We know that there was kind of an interruption, let's say, of legal immigration, which is important for our labor force because our birth rate is just not great. It's not specific to the US. All developed economies
Demographics
have
are
the demographic stuff. I mean, it's really kind of Africa and India that have okay demographics, and everybody else is kind of going the other way, right?
So why is he trying to solve this problem with monetary policy?
He's not going to solve it with monetary policy.
Right,
It's not going to be.
point.
It's not going to be solved. And I think going back to Powell for a moment, you got to be a shrink a little bit. And I'm not a shrink, okay? But you kind of observe people. He says stuff like, I don't want. He says, look, there's going to be a debate. This is what's coming, right? You're going to get jobless claims going up. You're going to get the unemployment rate going up. The unemployment rate is at 50-year lows, 3.4, right? And the senators from different states are going at Powell and saying, remember, your job is jobs. Don't get freaked out by inflation. It might be transitory or whatever. Just don't worry about it. And remember the cycle stuff I was showing, how it can kind of, you get lower lows in your cycles if you don't deal with it. There's plenty of things to worry about for structural reasons on inflation. Reshoring of supply chain, structural shifts in the jobs market where we don't have as many people to work. Productivity, we haven't even talked about productivity growth coming down. I mean, if you believe if you want to believe the numbers, and let's take them at face value, we have very strong jobs growth, and I think it was Hatzius said of Goldman this week. I don't do this work. We don't do the kind of guessing of the point forecast for GDP. We do the cycle directional calls, but let's take him, let's assume that they know what they're doing. He's got a 0.4 GDP growth. Now, if you're adding that many people and that's your GDP growth, your productivity is deeply negative growth. And that's critical to profits growth. And even let's circle back to the Fed for a minute. They want to get to 2%, right? Let's say that is the true goal here. Wage inflation that's related to a 2% target, the Fed's target, wage inflation has to be about 3.5%. But that assumes, the assumption there is that productivity is running at 1.5%. And it's deeply negative right now. We're not where we assume we are. So that would imply that the target has to be lower if you want to get where he's saying. So all of this is to say that Powell, is he, if I had to do the mind reading of him and wonder if he's more worried about a recession or more worried about inflation getting embedded, I have to say he's more worried about inflation getting embedded. And I just see in the chat with the political component, he is going to get some serious political pressure. Maybe because he's got a pot of gold, on the side. He doesn't care so much about money, and he cares more about his legacy.
Right.
And if he doesn't want to be the second coming of Arthur Burns, and he does want to be the second coming of Volcker, I don't know how it manifests here. We've got an inflation cycle downturn, but I say that you know, I don't see a pivot anytime soon. You're going to have the recession underway, and the market's kind of grappling with recession, I think, for there to be any kind of
well, in his legacy, if he follows through with an already weakening picture, his legacy, part of it will be a modern day Hooverville across the United States.
Well, he'll be vilified for sure. I mean, because again, remember, we're at 3.4% unemployment, and he's getting incoming fire right now.
Yeah.
So I don't know where you want the unemployment rate to go. When you go to the structural issues in employment, right? So you have people who've left the workforce, then you've got all that bottleneck stuff, the craziness that happens. So housing goes to the moon, tons of demand for housing. So construction worker unemployment rate is like something crazy. It's like less than 0.5% or something. I think it's like a bonkers number. It's crazy, right? And there is stuff in the construction pipeline, jobs that haven't been done. Incoming demand has plummeted. There is no incoming demand for new build. That's not really there. There's stuff in the pipeline where if you've got the worker that you weren't able to get during past quarters or past couple of years, you're going to hang on to them and finish your work. But when you look forward, what's my incoming demand? That's dropped off a cliff on the construction side, both residential and non-residential. I mean, there's a little multifamily stuff because people can't afford to buy a house, right? So those millennials can't really afford the housing affordabilities, even if it's improved a little bit with mortgages going from 7 to 6. It's not a game changer. So I think in construction, I would watch the construction unemployment rate as a front line of where this is going to start to move. And then in manufacturing, you also have some of that because you had a lot of those bottlenecks, a lot of backup in production. Now the components are in, so they're doing a little bit of building. But in both sectors, which are huge cyclical sectors of the economy, not even the forecast, the activity, the actual just what's going on is decelerating pretty darn
So
hard.
when is Main Street going to know they're in a recession, Lakshman?
Well, look, Main Street, I think is feeling it. It depends how much money you've got, right?
Like
if you're working, look, if you're working and living paycheck to paycheck, I think you are feeling it.
Yeah, you are.
If you've got some assets, then you're not immediately impacted by this. But just to be clear, just to look, in a recession, what 8% of the people are going to really feel it and like lose their jobs or something like that in a regular kind of recession. It's not like this huge thing. Most people are like, oh, okay, that's a little tight. I see things around me that look weak. But you have industrial production levels are down, consumption levels are down. Okay, so when I'm working with clients, they certainly are hearing all the bull cases that are out there and watching the market go up a bit and saying, whoa, is there no where is the recession? Do we see it? And you see it in the consumption. The consumption has been actually
dropping.
That's
a problem in a consumer-driven economy.
It is, and it happens. What happens is the service sector and consumption, these things, the deceleration, the slowdown that happens there, they don't always contract during a recession. Plenty of recessions where they don't contract. They always slow down. That often happens after the recession has begun. So industrial production is down, consumption numbers are down. Looks like GDP is going to be pretty weak. We understand why there's the labor hoarding. We understand why jobs are tight. I don't know if the actual number itself of 500 is right. You know, there's always plenty of stuff in the details there, but eventually that washes out. So I do expect that sooner or later you are going to see jobs begin to contract. Probably not from service sector stuff. Probably from other sectors is what'll be driving it.
You're going to be watching construction as the key.
Well,
to that.
it's one canary, but there's many. It's also in manufacturing. You've certainly seen some companies really kind of screw up. I mean, I think they Intel, right? They kind of whiffed it, and because they were just like, hey, we're going to keep adding people, adding capacity right into a downturn. That's not going to work. You're going to have to now. Other companies like TSMC, I think they're a little bit more. We work with them; they're a little more sensitive to the cycle. I mean, they've managed it really well. They've been able to kind of ride the wave instead of kind of get smacked in the face by it.
I think that people think these are small cuts, but they are deeper, the more to the bone kind of cuts than people really think.
Yeah,
Microsoft, etc. So, you know, we're getting into this time zone where I'd like you to encapsulate, if you will, your outlook. Why don't we do it with the standard analogy? Soft landing, hard landing.
hard landing. Hard landing.
As an ETA.
Sooner rather than later. I mean, you know, look, the way these things work, and people do not appreciate this. You're very lucky to see a recession when it's starting.
All right.
You know, everybody's a genius on Monday morning, you know, Monday morning quarterback. Yeah. Like, it was obvious, you know, and I'm sure when this recession is recognized, everybody will say that they called it. It was obvious. But remember that, you know, 10% rallies as a recession is starting are normal.
Right.
This is
so, you know,
that's not abnormal.
I'm getting some real nice comments about your narrative here.
Okay.
And maybe you could show your website, Lakshman, for people that I know you mainly handle large businesses and institutions come to you, but I think you have a product where retail people interested in your views on the economy could stay informed with your work.
Sure.
So you just hit the share screen.
Oh, do I have that up there now,
or I could do it? Let me
here. I got it. It's businesscycle.com.
Right.
Is our
website.
Site. Yeah, that's our website. I'm sorry. I'm like,
it's okay.
I got you in a tiny screen. I got to get you in a big screen, and then I have to share it. Sorry.
It's okay. And there we go.
So this is actually, you know, by the way, we're launching this site's getting launched today or tomorrow. So it might look a little different, but it's businesscycle.com. It kind of shows you you know, different parts of what we do, the people we work with, you know, so we'll work with like a big sovereign fund or a big industrial or a consumer company there. So like Parks, I know Parks have, you know, they do well because everybody's been pent up, right? For a couple of years, you want to get out. But discretionary spending, look, discretionary spending is cyclical. So,
right.
Yeah, we totally need our phone, right? But do you need the latest iPhone right now?
No, you don't. No.
Okay, so that's the thing. So that once you're that big, you can't hide.
Right.
So that's the stuff that we have to deal with. And since I have you here, I want to show just one other chart very quick to drive home.
So I mean, that iPhone argument you bring up is another stress on consumption.
Yeah, these are the things. Yeah, it's just
that's what we're just going to have too much stuff except what we eat and need for to drive and to heat and cool our homes.
I might have
Just the
showed you.
necessities.
Yeah, well, certainly. So all it really takes, right, is a deceleration in consumption, which happens inside a recession,
Right.
to kind of kick it. We're already having it in housing. We're already having it in manufacturing. Services, we've got it. We had pent up demand for services. Okay. And maybe there's a little more of that. There might be a couple more months of that. And then the deceleration kicks in. When services kind of just flattens, the other parts are contracting, you got a recession. This is 21 countries. I just want to show you. That's a forward-looking indicator that's very recessionary. And it's just coming off its lowest lows because it's not decelerating faster, right? So,
Okay. You're not showing it, Lakshman, and we'll wrap it with this look.
God,
it's okay. So
I thought I was sorry about that.
You're showing your clients, which are the best.
This
Fortune
is the
500 companies. Okay.
Here, can you see this now?
Yeah, we got it.
Yeah. So here's a forward look globally. Just coming off the lows, meaning a little less bad in the growth rate. But when you think about the math, it's the index level that's the key thing. So the level is still slipping. It's just, it was going down really fast and now it's going down a little slower. So that's the forward look. There's no recovery in sight yet. This is globally. Now, typically, if this is going like this, in some way, shape, or form, the central banks start to figure out, hey, we want to loosen up a little bit.
Yeah.
And so here, when this is coming down post Great Recession, they really want to be first they're tightening, then they turn around and they slam it down. They all turn around, and this is, I forget what this was. They had so many marketing names for what they were doing. In 2011 was that Operation Twist, maybe?
Maybe Chubby Checker.
I don't know what it was. So here we got to think of a new name because it's coming. Okay, they are going to turn, but my God, are they late?
Yeah.
And that has a lagged impact on the cycle.
Economy. Yeah.
Yeah. So that combination just is going to weigh on things, and so. Yeah, we've got a rally. Yeah, we have some hope that there's a soft landing or no landing or an immaculate disinflation. Is it impossible? I never say never. I have not seen anything like that. We don't see anything in a couple hundred years of cycle history that suggests that. The big picture stuff that we see about cycles suggests definitely first hard landing, and second, I wouldn't rule. I can't say it'd be a soft recession.
Okay. All right. So we really thank you. Your view is you made your point, and great discussion. I really enjoy our conversations.
Thank you, Dale. I love coming on and the back and forth, and I'd love to get into some of the comments that you guys have, but we'll do it next time.
We will, and we'll do it soon. Lakshman, follow Lakshman, everyone, at Business Cycle. Go to his website.
Yeah, we're on the website, or we're on Twitter, or we're on LinkedIn.
You know what we have in common, Lakshman, before I say goodbye? You and I both live in the future.
Oh, yeah.
I'm always projecting where I think, Mark, and you're always projecting. We don't have to go back to the future because we live in the future.
Yeah. No. I go, time is a tricky thing, right? Forecasting, thinking about time is a really interesting thing. Not everybody's used to that.
Yeah.
Thinking about time. It's maybe some options traders are.
Yeah. Time erosion. It's our most valuable currency. Anyway,
there you go.
Thank you, Lakshman.
All right. Thank you. Have a great day.
All right. You're welcome, everyone. People are thanking you, Lakshman. And
thank you, everybody. Thanks for listening.
And you could join the team in 6 minutes on the Morning Edge. Remember, don't just count your graphs, count your blessings. See everyone tomorrow. Thank you, buddy.